It's Friday, 25th of April, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and joining me is Neil Shearing, Group Chief Economist, and I'm happy to say we're joined this week by Jonas Goltermann, who's our Deputy Chief Markets Economist. Hi, guys.
Hi, David.
Hi, David.
Another week in Trumpland. We're nearly done. I should say it's 9 a.m. London, just for context, because market narratives in this climate can shift from hour to hour. Lawrence Welk was a US TV star in the 60s. Apparently, he said, there are good days and there are bad days. And this was one of them. Well, I think there are good weeks and there are bad weeks. And this does feel like one of them, doesn't it? Things are looking a bit brighter, but it doesn't feel like we're anywhere near being out of the woods. Neil, does that sound about right?
It does. Another way of thinking about it is it's been the kind of proverbial week of two halves, hasn't it? We started with a bit of a mess in equity markets on Monday. Markets in Europe closed, but in the US, we had those comments from Trump, another broadside against Powell, a big sell-off in the equity market, a bit of shakiness in the bond markets, and then walking those comments back and seemingly some noises that trade deals might be coming, or at least agreements with some countries on trade deals might be coming, and dialing down some of the heated rhetoric on trade with China, on tariffs with China. And that's contributed over the last few days to a rebound in equity markets and strains in the bond market subsiding. So certainly a better few days in markets, but I'd caution that all of this is still hinges essentially on the rhetoric of one man, who, as we know, have come to learn, is increasingly volatile. So for now, things set on a steadier course, but it remains to be seen for how long that remains the case.
Yeah, and as I said, we're talking Friday. There's a report Bloomberg has saying China is exempting some US goods from tariffs like MRI and ultrasound machines, some chemicals critical to manufacturing. But that's really because there's this urgent need in Chinese industry for these goods. There's really no meaningful sign of any bilateral contact that's enough to de-escalate and get a deal done.
On that front, I think there's conflicting messages. Trump has said that the two sides are in contact. The Chinese have said that's not the case. From the outside looking in, it seems to me that there's efforts on both sides to limit the immediate economic damage caused by these tariffs. So we've seen the US exempting products like consumer electronics, which would cause considerable harm to its economy. And we've seen on the other side, China, as you say, exempting some products from its tariffs on the US too. So I think an attempt on both sides to limit the immediate economic damage by these tariffs. And I guess in that sense, there's a recognition that tariffs do harm, at least in the short term, and some attempts to limit that, as I say, but not yet a meaningful pathway to negotiations that would lead to a lasting reduction in these tariffs.
Okay, what about in the data? We've had a slew of data this past week, not least the PMI readings. Has there been any signs in there of an unfolding global trade war disaster?
We're still probably a bit too soon to be looking in hard data for evidence of trade war disaster. In fact, if anything, because consumers tend to front-run tariffs and firms will tend to front-run tariffs, and others bring their purchases forward to avoid the tariffs, we're likely to see a bump in sales in the short term, followed by a slump in sales once the tariffs come into effect. So nothing in the hard data, but you're right that the soft data, the survey data, do seem to at least hint at some effect from tariffs. So if you take a step back and look at the flash PMIs we had for April earlier this week, they look pretty stagflationary. Output balances falling in most countries, new orders balances falling in most countries, particularly in the US, and input price balances rising in the US too, potentially reflecting concerns about tariffs. It's interesting that input price balances didn't rise in, for example, the Eurozone. So it does seem to be that US firms are anticipating higher input prices. And again, you can attribute that to the tariffs. But one word of caution, the relationship between the survey data, the soft data, the PMIs, and the hard data on things like industrial production, retail sales, and GDP have been pretty weak, particularly in the US over the past couple of years. So I don't read too much into it, but there is at least a kind of sniff of stagflation in the PMIs from April.
And looking ahead to the coming week, we've got another US employment report coming for April. What are the expectations there in terms of shifting the narrative for better or for worse?
For what it's worth, we're forecasting an increase of about 150,000 in non-farm payrolls. That's because the drag from cuts to the federal workforce still appears to be pretty small if we look at the high-frequency data. It's likely, though, that we think the unemployment rate perhaps ticks down a bit to 4.1%, given slower pace of growth of the labour force. And we're forecasting average hourly earnings growth to be unchanged at 3.8% year on year. So another so-so employment report, I would say. No signs of capitulation in the labour market, but equally it's pretty evident that the labour market has cooled from that kind of red hot temperature that we had only 12 months ago.
Jonas, I want to bring you in at this point because Neil's talked about the sort of brightening of mood in markets. There's a term floating around about hopium, that's what investors have been smoking. Is that the case, or do you see that there's a fundamental shift at work here?
Yeah, as you say, equities have rebounded. I think that's out to maybe, I break it down into three factors. The first and most basic one is that market functioning has calmed down after the big shock that we saw on April 2nd and in the aftermath of that announcement. So you saw a massive deleveraging across a broad spectrum of markets, especially bond markets, but spillovers across equities, currencies, credit, and so on. And that kind of shock, if you will, does seem to have run its course now. So we have a bit more stability, and that is allowing markets sort of equities and more broadly to stabilize and rebound a little. The second point is that data and earnings reports and stuff that we've had over the past week or two have been, I guess, broadly speaking, okay is the way I will put it. Nothing amazing and some worrying signs, as Neil mentioned earlier, but also no clear and obvious signs of an imminent major slowdown. If you think the sell-off at the start of this month and the start of the year more broadly, it's been based on a fear of a recession coming very soon. And so far, that's just not in the data. Not that you would expect it to be. This is still mostly lagged information. The trade shock won't show up yet in the data. But for now, I think no news is good news. And the third point, and maybe this is the most important one, is that the Trump administration has signaled a bit more of a constructive stance over the past few days. They've rode back, obviously, a bit further on tariffs. They've been emphasizing these negotiations, so raising hopes that the tariffs and the trade war will not last that long, or at least be partly unwound. It won't be as bad as initially thought. And as Neil mentioned, Trump also reversed very quickly on those reports that he was considering firing Powell, which is another strand of Fed independence, which is something markets worry about. And overall, the specifics on this is less important than the sort of broader tone. I think what we've learned is that there's a greater responsiveness to what you might think of as the feedback from markets and businesses on the administration's economic policy and an openness to adjusting. So I guess you could think of that as a version of the Trump put that people talk about. A bit messy, but better than nothing. And so that, I think, is providing a bit of reassurance. Now, that could be a pretty shaky foundation for trying to build a sustained rebound, never mind the market rising back towards where it started the year. Trump has proven over and over that he's a pretty unpredictable character. There are a few signs that the trade negotiations are actually going anywhere fast. The data, as Neil was saying, probably will deteriorate to a degree at some point before too long. So, as you said at the top, things are a bit better for now, but I don't think we're out of the woods yet.
Yeah, and markets have been trading on this idea of US exceptionalism for so long. I guess that trade is now dead. I mean, the US is exceptional in as much as you have this highly unpredictable person at the top, and things could go either way. It's notable, though, isn't it, that for all the recovery we've seen in some parts of financial markets, we really haven't seen the dollar come back. Do you think that's going to change?
I think it might to a degree. In a sense, the dollar is a reflection of relative prospects US versus the rest of the world, and that's changed less than markets are more optimistic about the absolute prospects for the US and other economies, but the relative one has changed less. And there's also a lot of cross currents still in FX right now. Dollar disconnected from interest rate differentials at the start of the month in a very unusual way. That seems to be going back to normal, touch wood. The relationship with equity markets has also changed. The dollar's going up when the equity market's going up, and that's not as unusual, but it is a bit different from what you think of normally the dollar as a safe haven. But I think the main reason it hasn't rebounded is the market's now building in an expectation that the Fed's response to all this is going to be to cut policy rates pretty soon. Either markets looking at either June or July as the most likely first cut, and several more cuts after that. over the rest of the year, and that that obviously is a dollar negative if it were to happen. As Neil said, we don't think the Fed will do that. We think their response is going to be to stay on hold for the rest of this year and well into 2026. If that proves the case, then I think that is what would lead to a bit more of a rebound in the dollar if the Fed stays hawkish or stays on hold while other central banks respond to this by cutting interest rates or just continue to cut interest rates in a way that they were probably planning to do anyway. So I think that is what you need to see to get the dollar to regain more of the ground that it's lost over the past few months.
Your team had a note out earlier this morning. It looks at how the worst does seem to be over for the dollar, but it also says that, on the one hand, there's grounds for a near-term recovery, but on the other hand, that the dollar is overvalued and at risk of further weakening down the road. So square that circle for us.
So I think the idea of a short-term recovery is based on the sell-off for the past few weeks having been maybe at this point somewhat overdone. There's been an overshoot, to use the technical term. You'd expect some mean reversion. Mean reversion is a very powerful force in markets generally, and especially, I think, in currencies. Almost any time you see a 10% fall in a major currency, it starts to look like, at least in the near term, a bargain to some people, right? Because it's 10% cheaper than it used to be. In particular, as I mentioned earlier, the idea of a rebound is based on the market's interpretation of how the Fed will react to all this isn't quite right. We're expecting to stay on hold and other central banks to cut. That points to a stronger dollar, certainly under normal circumstances. And I think it will still most likely work now too, provided there isn't further big negative surprises from the administration. I think that gap between dollar and rate expectations, maybe it unwinds, but I think at least it stops widening. And that's how you get a rebound in the dollar. Now, on the longer term picture, it's quite different and a lot less constructive for the dollar, because even after it's fallen 10%, it's still a pretty long way above its long-term average. It's been overvalued. Came into the year very overvalued and has been overvalued for a pretty long time. So on a 2, 3, 4 year basis, you wouldn't say the dollar was cheap, far from it. And over that horizon, there is certainly plenty more scope for further depreciation. That I think the outperformance of the US economy and the broader US exceptionalism narrative, it's hard to see that coming back, at least not nearly as strong as it has been over recent years. And eventually the Fed probably does end up cutting interest rates, and that reduces another key support pillar for the dollar. So I think we probably are on a downward path now over that longer horizon. Our base case is that it's a very gradual one, a soft landing for the dollar, if you will. But clearly it could happen much faster in some scenarios, and the probability of that kind of an outcome has certainly increased.
Neil, given all that Jonas has said, where are we with all this speculation about how we're witnessing the end of the dollar's dominance in the global economy?
I do think in some senses the genie's slightly out of the bottle on this one. There's now pretty widespread talk about challenges to the dollar status within the global economy. I think that discussion muddles several aspects, in particular the dollar's reserve status compared to what I think is much more important, which is the dollar's widespread use, dominant use in international cross-border transactions, therefore the fact that the US effectively provides the financial plumbing for the global economy. I think that's far more important than whatever share of official reserves are held in dollars. And I think on that front, we're going to write about this later today. I'm going to write my note on Monday about this. I think some of the threats to the dollar are a bit overdone. In some senses, they're nothing new, of course. We had in the 80s fears that the yen might supplant the dollar at the heart of the global economy. Then we had the euro. More recently, we've had the renminbi. None of those challengers have really managed to dislodge the dollar. And I think that's for a couple of reasons. One is just the sheer depth and liquidity of US capital markets, the sheer size of America's economy, the fact that some of the challenges to the dollar's position having flaws, the euro lacking full fiscal and banking union, it's about the monetary union, the renminbi, of course, having some capital controls. So we should be cognizant of history here. We're talking almost 100 years to the day after the UK rejoined the gold standard. But of course, that pre-war system of global economic management unraveled pretty quickly in the Second World War and then was replaced by what we have now, which I think you perhaps call a dollar standard. So there's precedence in history for the dominant global monetary regime to shift. but I don't think there's a credible alternative to the dollar at this stage, certainly not amongst fiat currencies. And of course, other more radical suggestions, Keynes famously wanted an international currency that would place more of the burden of adjustments on global imbalances on surplus countries and not just deficit countries. That would require multilateral cooperation to create. And of course, that's not really likely when you have the US and China going at each other over trade and entering into this deepening superpower rivalry. So I think we're in some senses left with Churchill's version of democracy. That is to say, the dollar being the worst apart from all the other possible alternatives when it comes to the currency at the center of the global economy.
So, Jonas, in the absence of those alternatives, what's the likelihood of a dollar crash from here? I mean, this recent sell-off has given dollar doomsayers something to talk about, hasn't it?
I don't think it has. It's given us all plenty to think about. But I think if you take a step back, you need to separate out those two things, that the value of the dollar based on cyclical factors of the price that you pay to buy dollars, or if you're American, to buy foreign currencies. And the other thing, which is the dollar's central role in the global system. Those are two separate, related to a degree, but largely separate things. And the value of the dollar can go down, it goes up. You can have a bear market in the dollar without that necessarily affecting its central role in financial infrastructure and its reserve status. That's happened before in the 70s, in the late 80s, and the early 90s, in the 2000s. Those were all proper dollar bear markets where its value fell by more than 25%, much more than we've seen so far. But starting in each case from an overvalued level, like the one we have now. And you could call those periods dollar crashes. In some sense they were, but they didn't change the dollar's central role in the system. That's survived all of those decades, all of those various ups and downs. And I think what a lot of people mean when they say dollar crash and the risk of one now is about that loss of broadest of its key status, which of course would also almost certainly be accompanied by a very big fall in its value, in the dollar's value. And I think on that front, to see that kind of thing happening, Neil's point of a lack of alternatives is very important. If there was an easy and obvious replacement for the dollar, it would be much more at risk of losing that special status and seeing a big fall in the value on that account. And there are certainly reasons you could doubt the dollar. The US is still the world's largest economy by market value, but it's a lot less dominant than it was in, say, the 1950s or 60s when this whole system developed. The US debt profile is pretty worrying, both in terms of the fiscal picture, the federal government, and also in broader sense of the US economy's net liabilities to the rest of the world. The trends on those fronts are not great. They're pointing in the wrong direction. But the lack of alternatives means that the bar for a dollar crash in this sense is very high. It's not enough that the US is imperfect and maybe getting more imperfect by the day. Something else also needs to be a better alternative, and not just a bit better. It needs to be clearly better, because you have to overcome switching cost network effects. There's just a lot of inertia in the system that maintains the status quo and makes change necessarily pretty slow. I think the biggest threat that the dollar is, and always has been, not other countries and other alternatives, it's the US itself. There's things that this administration or a future one could do that would make the dollar no longer viable as in its current role. I don't think trade policy meets that bar. I think Fed independence, and maybe thinking about institutional quality more broadly, and fiscal sustainability, those are the two key pillars which, if they are eroded too far, that would tip the dollar into a real crash in the sense. And that risk does feel more real right now. That's why we're all spending a lot more time thinking about this in more detail and worrying about it. But the base case is, as it almost always is, it's muddled through in gradual change. That's boring, I know, but that's how the world usually works. And frankly, it's something we should be hoping for at this point, I think.
Jonas Goltermann there, hoping for gradual change rather than anything more dramatic. It's a sentiment I think we can all subscribe to after a frankly mad few weeks. I left Jonas to get on with finishing his new analysis about the long-term outlook for the dollar, and we'll post it to the show notes as soon as it's out. As Neil mentioned in that chat, his chief economist note, which goes out Mondays, that also weighs into this issue. As my chat with Jonas and Neil suggested, this is a story that's going to keep coming back. So it's good to take stock and get a firm grip of its fundamentals. Jonas joined me on a drop-in on Thursday to answer client questions all about the dollar outlook. There's a recording of that session, and I will add a link to the show notes. Our drop-ins are short-form online briefings. They last no more than 30 minutes to get you the analysis you need as quickly as possible so you can get on with your day. We run several each week. The coming week's schedule includes a look at Aussie inflation dynamics against the backdrop of its upcoming election, and a session on Wednesday, which marks Donald Trump's 100 days in office. The team will be looking at how the economic narrative has changed, what lies ahead, and much more. I will add details of those sessions to the show notes. Clients of CE Essential and CE Advance, our all-access packages, have access to all our drop-ins as well as all our written analysis and a full suite of macro and market data dashboards. Ask your account manager about these packages, and if you aren't a CE subscriber, well, what are you waiting for? Get in touch via sales@capitaleconomics.com and we will get you set up. That's sales@capitaleconomics.com. But that's it for this week. I will be back next week with Neil and the rest of the team. We'll be looking at that payrolls data, previewing the Fed and Bank of England meetings, and much more besides. Until then, goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.